Someone just blew up the $7 to $4 silver crime scene. Picture this. It's February 17th, 2026. You're on Wall Street at midnight. There's blood on the pavement, the kind you see in red and green candles. Gold is down $85. Silver is at $7 to $4.83, which should be impossible right now. Here's the kicker. U.S. aircraft carriers are deploying to conflict zones, and Treasury yields just collapsed. That's a fair trade. That is the market screaming something is broken in a language that normally sends gold vertical, but it didn't. Gold went through the floor. The suits say this isn't financial advice. It's a survival guide for a burning theater. I'm just a guy with spreadsheets watching correlations that held for 50 years break in real time, and I'm going to walk you through who just went bankrupt. If this makes sense, hit that like button. It's a fight against the shadow ban. The more engagement, the more people see this before it's gone. Now let's talk about what happened today, because this isn't just a price move. This is a crime scene, and I'm going to show you the weapon, the victim, and the suspect. The impossible chart. When mass stops mailing, here's the setup. It's the 17th of February 2026. Geopolitical risk is spiking. I'm not going to name the specific theater because that gets videos demonetized. But you know what I'm talking about. Carriers are moving. Defense stocks are up. Crude oil is showing tension. This is the environment where gold has rallied in every comparable situation since the 1970s. Every single one. The Yom Kippur War in 73, gold up. The Iranian Revolution in 79, gold up. Desert Storm in 91, gold up. 9/11s, gold up. The Iraq invasion in 2003, gold up. The Ukraine escalation in 2022, gold up. The pattern is so consistent that you could trade it with your eyes closed. But here's the second variable. And this is where it gets really weird. Treasury yields collapsed today. The 10-year dropped from 4.18% to 4.03%. That's a 15 basis point move in a single session. That's massive. That's not noise. That's institutional money fleeing into government bonds, which is a classic fear trade. When yields drop, it means bond prices are rising, which means people are buying safety. And when people buy safety in bonds, they also buy safety in gold. That correlation has held since Bretton Woods collapsed in 1971. When real yields compress, gold goes up. When nominal yields drop during a flight to safety, gold goes up. When both happen simultaneously during a geopolitical event, gold should go parabolic. Gold went down $85. Silver, which moves at roughly twice the volatility of gold, should have been limited down if gold was actually bearish on fundamentals. But silver didn't crash because it's bearish. It crashed to 70 for 0.83 because someone had to sell it. Not wanted to sell it, had to sell it. Let me give you the 3 historical examples that prove this is a forced liquidation, not a fundamental repricing. March 2020, COVID lockdowns are starting. The world is ending. Gold and silver should be moonshots, right? Wrong. March 9th through March 16th, 2020, gold dropped from $17.04 down to $14.80. Silver got annihilated from $17 to $12, a 30% haircut in a week during a pandemic. Why? Because hedge funds and dealers who were long precious metals got margin calls on their equity and credit positions. They didn't sell gold because they thought it was overvalued. They sold gold because they needed cash to meet margin requirements on their blown-up stock portfolios. By August 2020, gold was at $2,100. Silver was at $29. The forced selling created the opportunity. Remember back in 2011, during the Eurozone debt crisis, gold hit a record high of $1,900, then suddenly plunged $300 in just 3 weeks. Why? European banks were forced to sell their gold to raise cash. Fast forward to 2008, after Lehman Brothers collapsed, the financial system was on life support. Gold should have skyrocketed, but instead, it dropped from $1,000 to $730. Hedge funds were getting margin calls and had to sell whatever they could, and gold was the easiest asset to liquidate. This brings us to what I call the margin call theory. Wall Street has a simple rule they don't want you to know. In a crisis, you don't sell what you want, you sell what you can. When a hedge fund gets a margin call, they need cash immediately. They dump their most liquid assets, and gold futures are incredibly liquid, so they sell gold. Not because they're bearish on it, but because it's their ATM. Thanks for watching. Scenario 2. A bullion bank that acts as a market maker in precious metals had a hedging position blow up. These banks sell physical gold to clients and hedge that exposure by shorting gold futures. If the physical market suddenly slowed down, but they were still carrying the short hedge, and if volatility spiked today due to the geopolitical news, their value-at-risk models could have forced an unwind. They buy back their shorts by selling long positions elsewhere, which creates downward pressure even though the fundamental reason for the hedge is still valid. Scenario 3, and this is the one that keeps me up at night. A sovereign wealth fund or a central bank needed dollars immediately to defend their currency or meet a payment obligation. We know from the 2020 gilt crisis in the UK that even central banks can face liquidity crunches that force asset sales. If an emerging market central bank had to raise dollars today to intervene in their FX market, they'd sell their most liquid dollar-denominated assets first, gold. Not because they think gold is going to zero, but because they need greenbacks. All three scenarios share the same characteristic. The selling is mechanical, not analytical. It's not a bearish forecast. It's a forced liquidation. Why physical premiums matter more than spot price. Let's bring this back to what you can actually do with this information. The spot price of silver is 74.83 as I'm recording this. But if you go to Amex right now, or SD Bullion, or JM Bullion, you're not paying 74.83 for a silver eagle. You're paying $80 to $85 depending on the dealer and the volume. That's a $7 to $10 premium over spot. Why does the premium matter? Because it tells you the real market. The spot price is what happens on the COMEX futures exchange, where 95% of the volume is paper contracts that never result in physical delivery. The premium is what happens in the real world, where people who want actual metal have to outbid each other to get it. If the premium is widening while the spot price is falling, that's a massive red flag that the paper market and the physical market are disconnecting. It means the forced selling is happening in the futures market, but the physical buyers are stepping in to absorb every ounce that comes available. I'm seeing early signs of that same dynamic today. Spot is $70 for $83. Premiums are $7 to $10. That's not normal. Normal premiums on generic rounds are $2 to $3. On Eagles, for $1 to $5. We're already at double normal premiums, and the forced liquidation just happened today. If this continues for another week, premiums could go to $15, which would put the real price of silver at $90 even if spot is still at $75. Here's what I'm watching for: dealer inventory levels. If the big online dealers start showing out of stock on popular products, that's confirmation that the physical market is tightening. If the U.S. Mint reports allocation restrictions, that's confirmation. If the Shanghai Premium over COMEX widens beyond $10, that's confirmation. All of those are leading indicators that the paper price is lying, and the real price is higher than the chart shows. Final thoughts: the price didn't fall because the market believes gold is worth less. The price fell because someone had to sell, regardless of what they believed. And when forced sellers are done, the price reflects fundamentals again. The fundamentals say gold should be $2,700, silver should be $90. The fact that we're below those levels right now is a gift, not a warning. If you want to track when this forced liquidation completes, when dealer inventory starts showing strain, when the Shanghai Premium blows out, subscribe to the channel. This isn't a once-a-week update. This is a live tracking of the physical market versus the paper market to identify when the disconnect is so large that it snaps back violently. The price didn't fall. It was pushed, and now it's going to bounce. The only question is whether you repositioned for the bounce or whether you still trying to figure out why the chart didn't make sense today. I'll see you in the next one when we track the recovery.